Hello and welcome to Power Breakfast on Investonomics, an initiative of ICICI Direct. Joining us today is a very special guest, Parag Jhaveri, Managing Director of Yasho Chemicals. Yasho Chemicals has seen a multi-fold rise in its price from rupees 160 in Jan this year to currently trading around 645 rupees and is up over 390% in over a year. With the COVID pandemic accelerating the shift away from China to other countries, India looking to double its specialty chemical market share over the next 5 years, and the trust on Make in India, specialty chemical companies like Yasho Industries have a huge opportunity ahead and are expected to see solid growth as well. Thank you, Mrs. Jhaveri, for joining us today. Mrs. Jhaveri, your company has delivered the highest ever sales growth this quarter. Revenue has grown substantially year on year and quarter on quarter as well. What is capacity utilization at, and what target do you have for volume growth for the year? And of course, what run rate are we expecting? Is this sustainable?
Okay. See, for the March 21, we have achieved a capacity utilization of about 85%. Company decided to increase the capex and to increase the quantum from 9,200 to 11,000 metric ton in this year. We are hopeful we should be able to complete this expansion capex plan by end of Q3. So by December we will be fully ready to take care of for any additional demand. Currently, we are running with a growth of about 25% in the quantity growth. I generally like to measure my growth in the terms of volume, not terms in the top line, because the prices are volatile. We are into exports more than 65%, so the rupee going 2 rupees up and down will affect my top line, but that does not mean it will affect my bottom line. My bottom line looks it's look pretty healthy as of now. We are seeing a strong growth into the lubricant, rubber, and specialty segments, where we are focusing for last 3 years. Whatever capex we did, major capex has come in these 3 segments, and I think it is paying off very much. Top of it, we have done a lot of REACH investment. That is for the export of any chemicals to the European market. One need a REACH registration. And company has more than 30 product registered with a different tonnage band. And out of that, we have taken a lead registration for the 3 product.
Right.
So that is helping us also to grow very well into that segment part of the world. And I think the growth is sustainable,
Right.
Short to long term. What we see here, we see that a lot of chemical companies are merging or shutting down in the Western world. And that is also helping us to grow substantially in that part of the world.
Right. Parag, EBITDA has come in highest ever, about 22 crores. So it's fair to assume that potentially could be sustainable for the rest of the year, right?
See, we have 5 verticals here, the food and aroma. That's a one vertical on which company grew till 2010, 2011 strongly. Later on, we saw the lot of the competition coming from the importers into the aroma range, where they were cutting down the margins. The food segments, we have local competition, and we saw the margin dropping drastically.
Right.
We decided to move from 2016 onwards to the 3 other segments, that is rubber, lube, and specialty, and those are giving us a pretty good margins. And the shift is proving that we have taken the very wise decision, and that is showing us a very healthy bottom line. What you see that on the EBITDA.
Right. I want to talk to you, Parag, a little bit about margins and stay on that topic.
Sure.
Margins around 16, well, actually, yeah, but 16% this quarter. There has been a substantial growth year on year, but there's been a 1% decline quarter on quarter. I do understand that the industry is going through and seeing a raw material price increase, which is potentially or probably already driving prices up the value chain. Apart from this, of course, shipping rates have increased 2 to 5 times over the last 1 year due to container shortage. Have you been in a position to be able to pass on this cost rise to your customers? Or if not, when can we expect that? 16%, like I said, is a quarter-on-quarter decline, but are these levels sustainable for the next couple of quarters this year, or could we see some more pressure before things stabilize?
Well, Samina, we are working with our customers where we can easily pass on. We work on a 3 months pricing strategy,
Oh,
6 months. So there's either of either 3 months or 6 months. If some sudden impact comes for a 1 month, that has not been passed on, but definitely we pass on our price impact. All our freight costs, not in that immediate shipment, but the subsequent shipment, we are passing on, and the customers are very well knowing the fact that the freights are going up. So they might ask us to just honor the first order what is in hand, but the subsequent orders it's been passed on easily. So and also if you look at, we have a multiple product here. Depend on the what's product we from the what vertical we sold more can reflect our bottom line. So here again, that the Q1 has a little different product mix compared to the Q2, but in a long run, yes, this is sustainable. I'm pretty sure, I'm pretty confident on that part of it, because we see that the consistent increasing demand for our three segments where we are focusing, and I don't see any problem there.
I'm glad you bring that up, because I do understand, and I went through your presentation as well. You're working actively to increase rubber chemicals, lubricant additives. That space, of course, has superior margins, and there's a huge or a better export opportunity there as well. What is your market share for these products, and how are you looking to increase your wallet share? Currently, I believe the market share there is 44%. Talk about that, and also tell me what, keeping that in mind, could we see an upside risk to your margin in the next couple of quarters if you're going to increase your market share here?
Well, our markets are pretty negligible when you talk about the global size of it.
Right.
We are too small in this segments. The immediate local peers in the rubbers are producing thousands of metric tons. We are not there. We are too small. So we are trying to increase our market share by adding a capacity here. Okay. Same also in case of the lubricants. We are fraction in this whole market which is existing. In India, yes, we do command a reasonable market share, but India is not the major focus point for us. Our focus is more for global market, where we have a bigger reach, bigger recognition. Another aspect you must understand that, Samina, that here the entry levels are very, very tough. Lubricant entry levels happen between 2 to 4 years minimum time gap, where people get the final approval, and then the business kicking. So this process has started from 2016, 17, and 18, where we have started a lot of approvals, and out of that, many are coming in since last year, end of last year, and beginning of this year. Multiple reasons: supply security, the supply chain. A lot of reasons are there where the customers have been forced to take a quick decision, quick look at it at an alternate supply base. India has to emerge strongly. We need to have a consistent pricing. We can't be an opportunistic here. Right. So there is because if you want to play a long term, we need to be a reliable, sustainable supplier rather than an opportunistic supplier who want to take an advantage every stage. So that will not help to the country. So yes, our growth sometimes may fluctuate 0.5%, 1% quarter on quarter, but a whole year on year, I think we have a sustainable margins. We can grow at least by. We are looking at the capacity full utilization of 11,000 metric tons somewhere in end of 23 or somewhere in 23, 24, mid of that.
Right. Mr. Jhaveri, so what, if you can just sort of give me a range in the rubber chemical lubricant additive space, what is the kind of margins you're picking up in the export market?
Well, margins, when you talk about gross margins or you talk about EBITDA, let me know. Let's talk on that either way.
Let's talk about EBITDA.
EBITDA is something about 20 plus. margins we talk about.
So that is a very healthy double-digit sort of margin picture. And if we are expecting that business to pick up, what sort of revenue share can we expect in the next couple of quarters to come from these three products?
Well, currently from this product, we are at about 60%.
Okay.
And, going down the road, these three segments will bring in the top line about 75%.
So then it's fair to assume that there is an upside risk to margins, right, Parag? We could be looking at 18 to 20%. Is that a fair assumption for the next 3-4 quarters on margins?
Absolutely. I'm not looking more than 18.5 or 19% margin for next 3-4 quarters.
Right.
Let's not put a very big margin upside.
Let's not get too aggressive also.
No, absolutely not. There's no reason for us. So we are comfortable.
18% is what we should be expecting on blended margins at the company level. Also, talk to me about your product mix. You did say that the verticals are really split into the higher margins and the low margin products, which are highly competitive in nature. Are you looking to add any more products in the pipeline over the next few quarters? Can we expect any announcements on that front?
Well, we do keep on adding product quarter on quarter or year on year.
Right.
Look at the history. We have today more than 140 products in our portfolio. Everything is in-house developed. So we are a very strongly backed R&D-driven company here. Whatever we are producing has been developed in-house. So we are proud of that. We do add a product, and we have added a lot of product into the rubber lubricant segment in the last couple of quarters. Beginning of this year, we add one more product into the rubber category, which is also driving us a very healthy growth in the top line and bottom line. Both is helping us. And we are in process of adding a couple of more chemistry in the phases of rubber lubricant specialty stand. And that will be keep on going. I can say it's an ongoing process for the company to add the product year on year. Although we can't sustain, we need to add new chemistry because we know that the approval times are longer. Even though we are present with an existing customer, they have a set of procedures. It takes time to give an approval. So we know that. So we are adding product. We go to a customer. We say, hey, we are here. How do we start the process? And then the sampling, the pilot study, the field work and everything.
Right. Well, you have very long contracts with marquee clients internationally and locally as well. Are you looking to add or expand any more clients internationally and locally?
We do. That's our consistent approach. Otherwise, we cannot grow. If you don't add more customers, we cannot grow. So we are growing our customers in the range of big, the compounding size who does mixing, like globally Hexpol is there, the Vibra Caustic is there. We have added some name like Michelin in the last 2 quarters in our kitty. So yes, we are keep on adding them. We work with them for a long term. Here, the good part is we are not into the commodity segment, we are into the niche product line. So there are not too many approved sources, maybe 1 or 2, and that gives us a kind of a security for long term that yes, our growth will be consistent here.
Right. So these are long-term clients, but prices get negotiated every 3 months. That's a fair assumption, right, Parag?
3 or 6 months, yes. 3 or 6 months.
But of course, even if you don't have that benefit in this quarter due to a price hike, you can, of course, pass that on over the next few quarters, is what I understand. Also, how long is the gestation period between bidding for a new client and actually, acquiring that client? Because I'm assuming you are talking to a lot of people, like you mentioned. What can I expect, or what can we expect in the next 3 quarters in terms of client additions?
Well, as I told you, we already started this process a couple of years ago.
Right.
So we have added considerable number of clients in this year. Process is on.
Okay.
We have set up a company in Europe as a stock point,
from
where we want to add direct users. Until the last year, company approach was to reach to the global customer through a distributor network. Okay, so where you lose the margins and they have they take over.
That's going to be my next question. Yeah.
Yes. So now we have added our company. We are almost ready to kick in. So we are going to have a stocks in somewhere in Europe, from where we can reach to the customer end user. So it will be Right now it is from us to distribute to the customer. We
Right.
want to reach to the customer directly. So
Right.
that process is already on, and hopefully that you can see the results from last quarter, or maybe when we call the 22 quarter one.
I'm
That growth.
glad you bring that up. I just wanted to understand. So currently, the model that you're following, like you said, is from Yasho to the distributor to the client. What sort of margins do you have there? And of course, if you go directly to the marquee clients, what would the change be? So how many bips more can we anticipate while this process is currently underway?
See, right now, if you look at my total export pie, 30% to 35% we do the direct to the users, but 60-65% the strong, the big gap. We want to bridge that. First, now we are starting with the Europe market because it's a big continent. The many countries, number of customers are many more there, and the many people are showing a willingness to buy. But provided we have a stock in Europe, because they don't want to wait for a 8 to 12 weeks after placing the order. They don't have that visibility many times.
Yeah.
So we have decided that. Also, the reach is giving us a lot of trust, lot of push, and the confidence that yes, we can gain those customers who are sitting on a fence, who are not willing to buy directly, and sometimes they are not happy with those distributors because sometimes these are big. They don't give proper service, margins are very high. So we do looking at least a 5% upward in the margins when we go to the customer directly.
Also, I want to talk to you about capacity expansion. You said capacity utilization stands at 85%. Very obviously, there's no concerns on demand, either locally or even internationally for that matter, right? Where does capacity expansion's plan stand for you at? And of course, take me through where those plants are going to be. Is it just going to be the Vapi plant? Are you looking to add some more facilities locally? What is the plan? When can we expect that supply to come online as well?
Well, this 9,000 from 9,000 to 11,000 metric ton is going to happen in an existing facility at Vapi only.
Okay.
At Unit 1 and Unit 2. That's we are almost there by 70%. Balance will be done in next 2 months' time. So we'll be up and running by end of
months. Okay.
Yeah, it will be up and running.
And of course, given the global demand and the China Plus One that's playing out and the push from the government as well, could you be looking to add some more facilities locally?
Well, very honestly, we are looking at a new 100% greenfield project somewhere in Gujarat.
Okay.
It's in a drawing board at the moment, so I won't able to discuss too much on that. But yes, this capacity we are looking to utilize by end of 23 or beginning of 24 somewhere. So we need a new capacity, which will take at least 2 years to come up. So that whole process has started at the drawing board and when we have that we are not here to disclose that at the moment because we are not ready. Okay. Once we get all the approvals from government body, we'll make a disclosure.
Right. Also, keeping the fact in mind that the company is, of course, making new highs in terms of a stock price. Your valuations are looking absolutely amazing if you talk about the promoter stake right now. Around 70-74% is what the promoters hold in the company. Would you look to dilute that stake? Would you look to fund these expansion plans from outside money? And what I want to understand is because it's such a large opportunity outside and the price of the value of your holding is also substantially jumped, could we expect a QIP? Could we expect money coming in from outside to fund your plans and your dreams?
Maybe sometime.
So, okay. So QIP maybe on the cards is what you're indicating?
It's not too early. I think it's too early to talk about that.
Right.
Let's come with the new plant. Let's come up running, and then we'll talk about that.
Right. Also, this your balance sheet, right? I mean, your cash flow. Of course, I believe there's some amount of high debt. The cash flow cycle is such that that's what it leads to. Are you looking to improve that? Your net debt equity also is about 1.5 times. Any sort of work going on the back end to improve that and ease the pressure on the balance sheet?
Let me be honest, Samina, here. Yes, debt is a bit high.
Yeah.
But end of 21, we are looking at a debt of about 1.5, not higher debt, with the margins kicking in. So that at the moment, that might get little bit stretched in the process of new capex. But once capex kicks in, we are looking at some dilution at that level, and then the whole idea is to bring in the debt at 1 to 1.2 somewhere.
Right. So, of course, that's over the next couple of years. That's at least the plan on the cards. Very lastly, Parag, I know that India is talking about doubling up its specialty chemical space. You're lucky because the environmental norms, you, of course, abide by those, and hence you become a preferred supplier. And for a lot of potential clients, how much can we expect the contribution to come from you? So, if I have to extrapolate that 20 to 25% growth this year is what we're looking at, that is a run rate that will be sustainable for the next 5 years, or would that sort of increase as we go ahead?
Well, for this 25%, next year between 10 to 15%, we are almost touching our full capacity utilization. So the next growth will kick in a big way from 24 onwards when we come with the new capex online. So right now, what we are seeing this year, yes, we are seeing a fast filling up our capacity, but now we don't have any more room or any more debottlenecking. Everything is over. Whatever we can try our best. So that's why I told you we are looking at a new greenfield project that will kick in and continue the growth process of 20-25% growth margins from 24 onwards. So we don't see there's a big problem for next 5 years or 7 years horizon when I look at it. But we will be at least in a much stronger position globally on the supply side. We will be recognized force into the field of specialty segments. That's the aim of the company.
And also for now, India still is an important market for you, right? If we are looking at this growth coming in, is it going to be more local or more international? I just want to sort of get a sense of where will the revenue split come in over the next quarters or the next few years, really?
See, if you look at it, I don't know. If you study last 3 years, we are consistently much more above the 50% from the exports. We have grown last year to 60, and this last quarter we are 65. And I think that momentum will be continued next couple of quarters. So 65% on an average, we are looking at revenue coming out from the exports market. But that does not mean we are looking at 35% domestic market. Domestic market is also growing equally for us, side by side. What we are losing out is on a food and the aroma segment a little bit. I won't say losing out. We are holding what we are at 2018 capacity. Today is the same capacity. So we are not added any capacity on that. So you might see the top line not growing that fast because of that's to avenue give us a good top line, not the good bottom line.
Low margin business.
Low margin business. So that's the reason we are looking at the high margin business, but maybe top line. Yeah. So when I talk, I'm more confident about my volume growth, quantum growth. I may not be fulfill the aspiration of the investor of where the company has grown 25% top line or 30% top line. But I say, yes, my bottom line has grown. So what I'm giving assurance on the bottom line growth, I'm not giving any assurance on the top line growth. Couple of factors. Rupee, currency is a big factor for Yasho. The price volatility. And third is what do we call it? But these two factors will drive the top line. So what I'm looking at is a volume growth, quantum growth, and my bottom line healthier. That's my aim.
Right. Parag, you mentioned currency volatility, and that's a very valid point, given that 65% of your business is export driven. Are you hedged at these levels on the dollar rupee or the rupee really against the euro as well? Or is it more as you go along, you book in cash, you book in spot prices? So what is your hedging policy internally right now?
Okay. We have a natural hedge here. We import 75% of the raw material here, but we are still a little bit lost on the export side. Top of it, we are working with an advisor who is helping us on day-to-day basis on looking at our currency booking. So we do hedge. Okay. At times import, at times export, depend on what they give us advice, and accordingly we want. We don't do it internally. It's totally we take advice from advice, and they are on board for last 3 years, and I think they are doing good job for us.
Right. Right. Really happy to know that, Parag. That's all the time we have for this conversation. It's great going. The stock price is, of course, skyrocketing. It is a multi-bagger. And, of course, the situation is playing out. In fact, the stars seem to be aligned for Yasho Chemical to continue to do well and go to more heights. Good luck with business. Thank you so much for talking to us.
Yeah, thank you very much, Samina. Thank you.
Thank you.